Democratic candidates for president are taking aim at income inequality and abuses that they see in the U.S. tax code. Robert Frank joins us now with a look at what could be one of the biggest targets. Robert.
Good morning, Becky. It is one of the favorite tax breaks of the wealthy, and a growing number of Democrats say it's also a costly giveaway to the rich that needs to be eliminated. It is called stepped-up basis. Basically, it allows taxpayers to inherit businesses, stock, and other assets without ever paying tax on the appreciation during the owner's lifetime. Joe Biden has made getting rid of step-up a centerpiece of his tax plan, and Maryland Senator Chris Van Hollen is about to propose legislation killing step-up, calling it, quote, a major loophole that wealthy households use to shield their investments from income taxes. So here's how it works. Say an investor bought $2,000 worth of Apple stock back in 1999. Say it's worth about $200,000 today. If the investor sells it today, they pay a capital gain on that $198,000. So that's around a $40,000 capital gains tax. If that investor holds onto the stock until he dies and passes it to his family or anyone else, they never pay any tax on the gain. Now, the tax basis for the stock would be $200,000, the same value at the time it was transferred. And the heirs would only pay a tax on any gain above $200,000 if they ever sell it. So you got businesses, stock, real estate can all soar in value for decades without ever being taxed. And the best part, if it's given to charity, it's never taxed at all. Now, tax experts say step-up basis costs the government between $30 and $60 billion a year, and it also discourages the sale of stock and of assets during their lifetimes because there's really no incentive to sell.
And what a lot of people do is take loans against it. I mean,
that's right.
That's the other piece of this.
So you're effectively using the money without being taxed on it, is what you're saying?
Exactly. So one of the things that people do, by the way, interestingly, not only do people do it in this instance, but you know how we've talked about how people from Wall Street oftentimes, or from lots of businesses, leave their classic private sector and go into the public sector, working at the White House or wherever, and they effectively don't pay taxes in that period.
Because you're forced to sell your stock.
Because you're forced to sell your stock, so you save the money.
Government.
But eventually, ostensibly, you're supposed to
pay the tax on whatever those assets
are worth. But what most people do, especially people who are quite wealthy who can afford to do it, is they actually never sell the treasuries effectively,
right.
and they take loans against that. They pass them on to their heirs, and the tax is never paid. So it's just another example of
still a high cost. You have to go into the government to
True.
serve for a while.
No. But if you think about it, there are people who have
there was a discussion of Gary Cohn when he sold his assets.
Let's say you made $500 million in your life, right, in stock. You sell the stock, which normally you'd lose $250 million on. So in this case, you get to keep all $500 million. You then take loans against it, and then you don't pay any tax on it later. Right. So we're talking about a $250 million effectively payment. That's not government work.
And we should
say
the two reasons.
Benefit.
So the viewers out there are probably saying, well, why does it exist? There are two reasons. One is because it was assumed that the estate tax would basically be a double tax if you tax any gain during lifetime. Right. So that's the first thing. And that goes back to 1916. The other reason is that
that's legit, though.
The other reason is that it's very hard to determine oftentimes after someone dies what the cost was to them of an asset when they bought it, finding the paperwork, finding out what they paid for it.
Not anymore. That used to be the case.
Right.
Now everything's electronic.
And that's the argument that used to be enforced. They actually tried to repeal this in 1976. It didn't work because they said finding documentation is too hard. Most of the assets held by the wealthy now are financial assets that it's easy to figure out what your basis was when you bought it.
Well, there must be a way of doing either or. Either it gets covered in estate tax. But the first, how much is exempt initially? So there's a lot of stepped-up stuff that never gets taxed in.
So it's $11 million per person now, $22 million per couple. So
very few people.
About 1,900 people are now paying the estate tax.
So there's a lot of stepped-up stuff that's never been taxed.
Exactly.
Okay, I don't know what's the rationale if it was.
Well, when there was a real estate tax, then it made sense. But now there's really no estate tax.
Well, that sounds reasonable. All right.
Yeah.
I hate taxes, but whatever.